Big change coming to Australia's age pension around mid-June. Reports are spreading about a possible new rule and tax adjustment linked to Anthony Albanese's policy updates that could affect thousands of pensioners. If you're relying on age pension payments, this is something you cannot afford to ignore, because even a small change could impact your weekly income. Stay with this video till the end, because I'm going to break down exactly what's changing, who may be affected, and how to protect your benefits. No confusion, just clear updates. And if you want daily updates on age pension payments, pension crisis news, and real government changes in Australia explained simply, make sure to subscribe right now. This channel is built only for people who depend on pension updates like you, so join us and stay informed before anyone else does. Something massive is happening to the Australian age pension system right now, and if you're a retiree, a part pensioner, or even someone who's planning for retirement in the next few years, you absolutely cannot afford to miss what I'm about to share with you today. Because starting from this week, the rules around your pension payments, your superannuation, and how the government taxes your retirement savings are fundamentally changing. And the scary part? Most Australians have no idea this is coming. Let me set the scene for you. The Albanese government has been quietly rolling out a series of significant reforms to Australia's retirement income system. Changes to deeming rates, changes to the age pension thresholds, and now the centerpiece of what critics are calling the biggest shakeup to superannuation tax law in decades. We're talking about a brand new tax called Division 296, which officially kicks in on the 1st of July 2026, and right now, this week, is the last chance many Australians have to get their affairs in order before that deadline hits. So whether you are collecting a full age pension, a part pension, or sitting on a growing super balance, what I'm going to walk you through in the next few minutes could literally save you tens of thousands of dollars. Stay with me, because this one is important. Let's start from the very beginning, because you need to understand the full picture of what has changed and why it matters so deeply. Earlier this year, in March 2026, two separate but connected things happened. First, the age pension payment rates were increased due to indexation. This happens twice a year, in March and September, to keep pace with inflation and the rising cost of living. So right now, if you're a single full-rate pensioner, you're receiving $1,200.90 per fortnight. That's roughly $31,223 a year. For couples, the maximum combined payment is $1,810.40 per fortnight. Those numbers went up by $22.20 for singles and $33.40 combined for couples per fortnight in March. Now, those extra dollars matter, but what matters even more is what happened to the rules around how Centrelink decides whether you qualify for that pension in the first place. And that's where it gets really interesting. The second thing that changed in March was the deeming rates. Now, if you've been following retirement news at all, you would have heard this term thrown around constantly over the last few years. But let me explain it clearly, because it is the single most important concept for part pensioners to understand. Deeming is a set of rules that Centrelink uses to estimate how much income your financial assets, things like bank savings, shares, managed funds, and superannuation account-based pensions, are assumed to be earning, regardless of what they are actually earning in reality. It doesn't matter if your term deposit is giving you next to nothing. Centrelink doesn't care. They apply a deemed rate of income to those assets, add it to your other income, and then decide how much pension you get. For years during COVID, those deeming rates were frozen at historically low levels, 0.25% and 2.25%, specifically to protect pensioners from having their payments cut during tough economic times. But now, that's over. From the 20th of March 2026, the deeming rates have jumped significantly. The lower deeming rate, which applies to the first $64,200 of financial assets for singles and the first $106,200 combined for couples, has increased from 0.75% to 1.25%. The upper deeming rate, which applies to everything above those thresholds, has gone from 2.75% to 3.25%. Now, 0.5% doesn't sound like much, but let me put this in real terms for you. If you're a single pensioner with $300,000 in financial assets, which is not an unusual situation for a retiree who has sold a property, received an inheritance, or saved diligently through their working life, This change in deeming rates will increase your deemed income by roughly $1,500 a year. That extra deemed income is then run through the income test, and for every dollar above the threshold, your pension reduces by 50 cents. So you could find yourself receiving several $100s less in pension payments per year, not because your actual income went up, but because the government has changed the formula they use to calculate it. This is why so many financial advisors are urging their clients to act right now. There are still legitimate, legal strategies that retirees can use to restructure their financial assets in ways that reduce deemed income. Things like putting money into a newer style of account-based pension, adjusting the mix of assets you hold, or in some cases, even spending on things like home renovations that can reduce your assessable asset base. But these strategies need to be implemented before the rules lock you in, and time is genuinely running short. Now here's where the story gets even bigger. Because while the deeming rate changes and the pension payment increases affect millions of everyday Australians who are receiving the age pension, what the Albanese government has been doing with superannuation law affects a different but equally important group. And the two stories are connected in ways that most people haven't fully grasped. Let me explain. The government passed legislation in early March 2026, officially known as the Treasury Laws Amendment, Building a Stronger and Fairer Super System Act. And this bill introduces what is called Division 296 tax. This is, in plain English, a brand new extra tax on superannuation earnings for people who have a total super balance above $3 million. And it starts on the 1st of July 2026. That is weeks away, not months, weeks. Here is how Division 296 actually works, because the mechanics are genuinely important to understand. Currently, money inside your superannuation fund is taxed at a concessional rate. In the accumulation phase, when you're still building your super, earnings are taxed at just 15%. In the retirement phase, once you've converted your super into a pension account, earnings are taxed at 0%. That's an incredibly generous tax treatment, and it's one of the reasons why superannuation has always been considered such a powerful vehicle for building long-term wealth. But under Division 296, if your total superannuation balance exceeds $3 million, the earnings on the portion of your balance that sits above that $3 million threshold will now attract an additional 15% tax on top of what already applies. That effectively means a 30% tax rate on earnings for balances between $3 million and $10 million. And for the small number of Australians fortunate enough to have super balances above $10 million, the rate climbs even higher, to an additional 25% on earnings, creating an effective tax rate of 40%. Now, the government's argument is straightforward. They say that the existing concessional tax rates on superannuation were designed to help ordinary Australians save for retirement, not to allow extremely wealthy individuals to shelter enormous sums of money from tax. They point out that Division 296 is estimated to affect only around 80,000 Australians initially, a very small percentage of the overall population, and that for those people, the tax concessions they've been receiving are simply no longer proportionate or fair. And honestly, on the surface, that argument is hard to disagree with. Most Australians earning average wages will never have a $3 million super balance in their lifetime, and the idea that the wealthiest retirees should enjoy a 0% tax rate on millions of dollars of investment earnings is something many people find difficult to justify. But here is where the debate gets genuinely complicated, and where many financial experts have serious, well-founded concerns. The $3 million threshold in Division 296 is not indexed to inflation in the same way that age pension thresholds are. What that means in practice is that over time, as superannuation balances grow through compounding returns, as contribution caps increase, and as inflation slowly erodes the real value of money, more and more Australians will find themselves dragged into Division 296 territory, even if their retirement lifestyle is perfectly modest by the standards of the future. Economists call this bracket creep, and it is a well-documented problem with any tax threshold that isn't regularly adjusted for inflation. The government did build in some indexation. The $3 million threshold can increase in $150,000 increments, But critics argue this is insufficient to prevent the tax from gradually hitting the middle class of retirees in future decades. There's also a deeper technical issue that has caused significant controversy in the financial planning community, and it revolves around the way Division 296 calculates what counts as earnings. Unlike most income taxes, which are based on money you actually receive, dividends paid, interest earned, rent collected, Division 296 uses a broader formula that looks at the change in your total super balance over the course of a financial year. This means that even if your super fund hasn't actually sold any assets or distributed any cash, the unrealized growth in the value of your investments, the increase in the paper value of shares or property inside your fund, can still be counted as earnings for the purposes of Division 296. Taxation on unrealized gains is a genuinely novel concept in Australian tax law, and it creates some potentially awkward situations. Imagine a retiree whose super fund owns a commercial property that rises sharply in value in 1 year. They owe Division 296 tax on that gain, even though they haven't sold the property and have received no actual cash. They may need to withdraw money from their super to pay the tax bill, which could in turn force them to sell assets at an inopportune time or reduce their retirement income. For many self-managed super fund trustees, and there are hundreds of thousands of SMSFs in Australia, this creates real planning headaches. SMSFs often hold illiquid assets like property or business interests, and the prospect of a tax liability arising from paper gains on those assets, payable in cash, is something that requires very careful management. If you are an SMSF trustee and your total super balance is anywhere near the $3 million mark, the time to be speaking with your accountant and financial advisor is right now, before the first day of July arrives. Let's zoom back out now and look at who all of this affects, practically speaking, and what you should actually be doing about it. If you are a full-age pensioner receiving the maximum rate and your assets and income sit well below the Centrelink thresholds, your situation is relatively straightforward. Your payments went up in March, and you should ensure you have updated your Centrelink records to reflect any changes in your financial position, because it is your responsibility under the system to report changes. But the deeming rate increases don't directly harm you if you are already receiving a full pension, because the income test is only relevant when you are in the part pension zone. If you are a part pensioner, someone who receives some pension but not the full amount, then the deeming rate changes are the thing you need to focus on most urgently. The higher deemed income from your financial assets means Centrelink calculates you to be earning more, which in turn reduces your pension payments, even if your actual bank account isn't generating any more money than before. The impact varies significantly depending on the size of your financial assets. For someone with modest savings of $50,000 to $100,000, the impact might be relatively small. But for someone with $400,000 or $500,000 in financial assets, which is an increasingly common situation as more Australians retire with significant superannuation balances, the effect can be quite material. And if you have a super balance approaching or exceeding $3 million, or you know someone who does, Division 296 is a law you cannot ignore because it takes effect in 3 weeks. The first financial year of Division 296 covers the period from 1st July 2026 to 30th June 2027, and the first tax assessments will be issued to affected individuals in the 2027 to 28 income year. But the clock for planning strategies starts now, not later. Some people are considering withdrawing super above the threshold before the financial year begins. Others are looking at whether contributing to a spouse's super, thereby splitting balances, makes sense in their particular situation. Still others are simply accepting the new reality and building it into their financial projections. But all of these decisions require personalized advice, because the right answer is entirely different depending on your age, your income needs, your tax situation, and the specific assets held inside your fund. What all of this tells us, the deeming rate increases, the pension payment adjustments, and the arrival of Division 296 tax, is that Australia's retirement income system is going through a genuinely significant shift right now. The broad direction of policy is clear. The government is trying to ensure that public money, whether in the form of age pension payments or super tax concessions, is directed toward Australians who genuinely need support in retirement, rather than being disproportionately captured by those with already substantial wealth. Whether you agree with that direction or not, the policy is now law, and the rules have changed. The most important thing you can do right now, whatever your situation, is to stop assuming that the rules you understood last year still apply today. Book a meeting with a financial advisor or a Centrelink Financial Information Services officer. Pull up your MyGov account and check your current Centrelink record. Look at your total super balance and understand where it sits relative to the new thresholds. And if you're a self-managed super fund trustee, get your accountant on the phone this week, not next month. Because when it comes to retirement income in Australia in 2026, the difference between acting now and acting later could genuinely be the difference between a comfortable retirement and a stressful one. The rules have changed, the clock is ticking, and the Australians who come out on top will be the ones who understood what was coming and moved before the deadline arrived. Don't let that be you looking back with regret. Get the right advice, take action, and protect what you've worked your whole life to build.